Hey everyone, today we are underwriting a multifamily property here in Orange County to see if this is going to be a buy or a pass. And I thought it'd be really good to provide how I look at a multifamily property before we send it out to a client. The first things we do is we look at, should we buy this property? Does this make sense for us to buy? Now we're looking at it for clients, but it's got to look at it from that perspective first. It's got to make sense to us before we go send it out to a client. We vet all properties before we send to clients, and this is more or less how we look at a multifamily property. So here we go. This right here, we've got a 36 unit multifamily property in Costa Mesa. This is a very sought after market, the west side of Costa Mesa on 18th Street. So this property is first time on the market in 58 years. It's a good size asset. It's 36 apartment units, all 2-bedroom, 1.5 bath, townhouse style floor plans, which is very ideal. And again, it's a good size, $15,250,000. So this would be an attractive deal to acquire. Looks like a value add deal. It really hasn't been touched, but again, great mix, good upcoming location, and the rental market's very strong here. So this is why we picked this deal to kind of size through. So this is the broker OM. This was just launched to the market about 4 days ago, and it's getting a lot of interest. So let's take a look here. Good floor plans. This is the location. So really close to the beach. This is located in an opportunity zone, not too far from Newport. This right here on the east side is a better area. The west side's a little bit more rougher, but it's getting cleaned up. So let's find where the numbers are. The broker packages, the numbers are always the last in the back of the book. So all good there. But okay, so going into it, $15,250,000. They're showing a 2.9% cap rate on current and a 4.4 cap on market. Okay, here's the rent roll. They got the manager's unit. Okay, so the first thing that I see, it jumps out, they zeroed out the manager's unit. And the right way to underwrite it is you plug in a rent for the manager's unit and then you take it out in the expenses. So they might have either counted it twice or underwrote it incorrectly. So that's the first thing that I would look at there. They don't really have a solid numbers page here. Luckily, we already put one together. So let me move this over and let's take a look. So this is the same property. We went ahead and sized it at 15 million just to kind of go over it, look at it. There might be a little bit of flex on this deal, may or may not be. We plugged in 50% down because the rents are low. And we sized it at, it comes in at our numbers at a 2.4 cap going in. 2.4 cap rate, this is a 3 to 4 cap rate market on the current. 2's low. So that's going to be a little bit challenge. You're not going to be able to get the leverage you need on this. Most buyers are going to want 50%, maybe even better LTV, and a 2.5 cap. You're going to have to probably get some creative financing to get that LTV. Most banks are going to be looking at a 35 to 40% loan on this. So it's going to require a lot of cash down. So the first thing we do is the new taxes. We plug in based on the purchase price, what the new tax rate is going to be. A lot of brokers sometimes leave that out and they don't adjust for new taxes. The direct assessments is part of the new tax. So that is something we take a look at. And then as you can see, a lot of these line items are actual expenses that we pulled off the income and expense statements already to see what a true cap rate is. So you got your utilities. Those don't look out of whack. Those are all pretty much in line. The largest utilities, water here. These are separately metered for gas and electric. We want to make sure there's a pool expense because there's a pool. On-site manager went off actual, and then we plugged in a 4% off-site management fee and $600 per unit per year in R&M. This is going to come down to a 49% expense ratio, which is pretty high. And because of that, it's high because the rents are so low, so it's throwing it off. It should be around 38 to 40%. So we know we're looking at true realistic numbers here, and it's throwing out a 2.5 cap. We plugged in debt quote of 50% LTV, interest only, 3%. And if we bought this asset for $15 million and put down $7.5 million, we're gonna get a net cash flow on the existing rents of $134,000 a year. That's only 1.8% return on our equity. So this deal, you have to improve rents. let's take a look at the bottom here, the scheduled income, okay? We've got, again, all 36 2-bedroom, 1.5 bath townhouses, almost 1,000 square feet each, and the in-place rents is $62,000. We added back the manager's unit because they had that expensed out. So the blended rents are, if it's $62,310 divided by 36, your average rent is $1,730 a month. Your market rent's $2,500 a month. So there's approximately a 44% upside in rents as you turn units. Now you can't, I think the play would be here that as units turn, you go in and renovate and take to market. It's hard to get through this whole building. There's a moratorium eviction. We want to be sensitive to kind of displacing tenants, but a good way would be to transition the units. So one comes up for a vacant, you renovate it, maybe you approach the existing tenant base and you say, hey, look, we've just upgraded this unit, market rent's $2,500, we'll rent to you for $2,350, and you unlock their unit, they move into the new unit, and then you go into their unit, you renovate that, and then you transition again, and you try to get through some of your rents quicker and turn those units and get that rent roll up to market faster. And you're really only approaching select tenants that are good quality tenants that you want to retain long-term in the building. But there's a lot of upside here, so it makes sense to spend the 30, we're gonna see probably $35,000 to $40,000 per unit to renovate to get that upside. And again, 2,500 minus 1,730, that's $770 a month times 12. We're looking at about $9,240 in upside on average per unit. And let's just go with a higher number of 40,000. That's a 23% return on cost. So that makes sense. We want to be above 20% on the return on cost. So within 5 years, we're getting our money back for the money spent to upgrade the property. And we're also increasing the property's value when we do that. So it makes sense there, but the going in return is below market. So we just have to weigh, is this property worth us putting down such a large amount of cash, taking a below market return on it, doing work to get the property up to market, then having it making sense. You're gonna be, if we stabilize the deal at all across the board, $2,500 a month, our cap rate's gonna be 4.5%. And our cash on cash return is gonna be 6% because we get a little positive leverage because we're borrowing lower than our pro forma cap rate. So we're borrowing at 3% and our pro forma cap rate's 4.5%. So we're getting 150 basis points in spread there, which is kicking it to 6%. The first thing I would look at is, this is a pretty good basis for Costa Mesa, $416,000 a unit. That's actually a pretty good value. This asset's very scarce, very hard to replicate. If someone were to pass on this deal to find another 30, 40 unit apartment building in Costa Mesa with this type of mix, with this plot of land, this is on 1.5 acres of land, very hard to replicate. So there's definitely a scarcity value. It's not all the numbers. So this is kind of an interesting deal, a little tough. This would definitely be one that I would recommend a tour on. We're definitely going to recommend some of our investors that are in exchanges looking for good real estate to come into this market, tour it, see if they get a good feel for the asset. We're going to be looking for, deferred maintenance items. This is just going in. We're not even planning on what the property needs. For example, if the property needed all new roofs, well, we can't really raise rents for that. That's just an expense that we would have to put in the building, and we can't improve our return on investment. So if it needs a roof, obviously we need to allocate for that. If it doesn't need a whole lot of repairs and it just needs interior upgrades as unit turns, then that's actually a positive. So those are things that we're kind of weighing and going over as we look at this deal. But I'm a big believer in Costa Mesa. Again, I like the size, I like the mix. There's a good amount of parking here. So this would be one that I would move forward and look at. On this numbers page, we can actually kind of play with the numbers. What if we try to get the cap rate to match the interest rate? So let's just see, let's plug in 14.5. So we drop $500,000 in value and it only adjusts the cap rate 12 basis points. So you can see that it's gonna be really hard to get a 3 cap on this deal. So down to 14 million, you're only at a 265, and that does adjust for taxes, or it should be adjusting as the formula should be in there. So but your market cap rate's a 5. You got to do a lot of work and you got to do some CapEx spend to get there. If we went with a higher number, 40,000 a door, let's say you got eternal units, it's a 1.44 million in CapEx that we would have to spend to get here. So that's a considerable amount of money and time. But just from a scarcity factor, 388,000 a unit, I don't even think it's going to trade that low. I just know in the market, this thing's going to probably trade 400 a door or higher. So let's take a look at what that is. All right, 401 a foot, 400 a door, 2.5 cap going in. You're gonna have to put 7.2 million down and borrow 7.2 million. I just plugged in 3%. We could probably get some type of market rent program, loan, some type of hybrid bridge product where we could get maybe a little bit better LTV, maybe the rate's a little bit higher, but I'm just using 50% leverage at a 3% rate, interest only. And I would run interest only on this so you can actually get some cash flow and you can just take that and put that back into the building so you don't have to pay down the property. You're not receiving any cash flow and you got to put money back in it. I'd recommend getting a 3 to 5 year IO product on this so you can get through this building and just not put out more cash to do so. Use some of the surplus cash flow from the asset. So I think it's a deal. Looking at the numbers here, these numbers are pretty tight. I feel strongly about $2,500 a month. Now that rent could be even higher, but I think that's probably on the upper end of realistic. The Costa Mesa rental market's on fire, but that's a number I would use to kind of plan for. This is probably where we are going to look at it as it would be a buy. 100 grand, 200 grand more, $300,000 more, just because of a scarcity, I would still say this is something that I would consider. But we would just have to look at the condition and see how much deferred maintenance is on the asset, because it's just really hard to replicate this. So if a trade buyer really liked it, don't lose this deal over a few $100,000. But I would probably say at some level it's going to be a pass. It just depends on how bad you want it, but I think the asking price is a stretch, and that's just consistent with the market. I would say it's probably a pass at the asking price. Anything at the asking price or more, just for whatever my humble opinion, it would probably be a pass and just seek other investment opportunities despite the scarcity. But if this asset is anywhere from 14.4 that's actually a really good basis for the deal. And I'd be willing, if I had the money to buy this deal, if I had $7.5 million to put down, that would be something I'd be willing to take less of a return to have this quality of an asset in an area that's really cleaning up. So this is kind of how we look at underwriting a deal. We want to make sure there's new taxes. We want to make sure that we use the real utilities. We use industry standards for reserves and repairs. We're going to make sure that we use realistic on-site payroll and off-site management fees. And also we're looking at when was the date of last rent increase. So this is kind of a surface level underwriting, but I would look at data last rent increase. Can you issue out rent increases? Was that already taking place? What about a delinquency report? I mean, is there people behind? Is there 1 or 2 tenants behind, or is there a lot more? Those all need to be a factor. That'll be an issue with, you just need to know that on the front end. But when buying a building, the lender's gonna wanna know what's going on there. So there's definitely a little bit more to peel back, but I would probably model up, let's say these residents are all on month-to-month rental agreements and there hasn't been a rent increase in the past 12 months. The max allowable rent increase you can give right now is 8.6%. So let's just, for just rough numbers, take $62,310 a month, and let's just grow that number by 8.6%. So that runs it up to $66,668. So let's just plug that in and see what we got. So just plugging that in, if you were able to do an 8.6% rent increase across the board, and I know I counted that for the manager's unit, but I'm just doing simple math right now, that's gonna bump this up to a 273 cap on current. So let's bring that back down to the $15 million range, 280 cap. And again, I'm using cap as one of the metrics. I mean, it's price per foot, price per unit, GRM, and cap. And if you've got 4 out of the 4 that make a lot of sense, that's a great deal to buy most likely. If it's 3 out of 4, that's still pretty good, especially in a scarce market like Costa Mesa. So we're getting closer to a 3 cap. Let's see what 14.5 looks like. Boom, 293 cap. So we kind of talked about 14.4, 14.5. If you can issue out rent increases, that makes sense. You can, I know that's a skinny cap depending on where you live and where you reside. You know, looking at a 3 cap for a multifamily deal might be a little on the skinny side, but this property is going to appreciate. I mean, if we get this property to $2,500 a month in rent, and you go to, this is probably an exit cap, 375 to 4. You know, that number is going to be substantial. So you're going to make, you might not make a ton in cash flow, but you could make a ton in built up appreciation in the assets. So I think that's where the money's to be made. Unless you're just putting a ton down, right? That's really where the money's going to be made here, because eventually this will be 500 a door, 600 a door. I don't know when, but it's got all the right things going for it as a property's concerned. It's garden style, low density. You're on grade parking, carport parking, townhouse units, 1,000 square feet each. You just got a good piece of real estate, 1.58 acres. So it's going to be worth it at some point in the future. So I'd say this is a buy at 14.5. It'd be worth a tour. So what we would do at this point is the investors that we know that are in a trade with the capital of around, call it 6.5 to 7.5 million to put down on an asset. We're going to put this together, present it to them. It's already going to be vetted by us. We've already driven and put a fresh set of eyes on the asset, and we're going to go to them and say, hey, here's an opportunity you might want to look at. So more or less, that's the first blush on how we underwrite deals.